Picture this. A sitting U.S. president says he's removing a Federal Reserve governor effective immediately. Minutes later, the Fed signals that the governor remains in place unless a court says otherwise. Markets whipsaw, pundits debate, and ordinary borrowers ask one question: what happens to my mortgage, my car loan, and my retirement account? That's where today's story begins, at the intersection of law, central banking, and political power, according to Reuters reporting on the Fed's response. Set the facts. Here's what we know. President Donald Trump announced that he's firing Federal Reserve Governor Lisa Cook, alleging issues with old mortgage documents. Cook rejected the move, said she won't resign, and retained high-profile attorney Abby Lowell to challenge the action. According to the Washington Post and Axios, Cook's statement was unequivocal. She intends to keep performing her duties as a Senate-confirmed official while the courts sort this out. Why this matters. If you don't live and breathe central bank policy, you might shrug. But this touches a core feature of the U.S. economy, an independent central bank that can raise or cut rates without day-to-day political pressure. Independence, imperfect as it is, helps keep inflation expectations anchored. When investors start to doubt that independence, they often demand higher risk premiums. Translation: long-term borrowing costs can rise even if the Fed cuts short-term rates. That paradox is one reason scholars and markets care whenever the White House collides with the Fed, as explained in multiple analyses from major outlets like the Washington Post. Near-term backdrop. At the same time, the data backdrop has been leaning toward a rate cut in September. Many forecasters expect a quarter-point move, with a smaller chance of a half point if incoming numbers soften. According to Reuters and PBS NewsHour summaries, markets are pricing in easing at the September 16th to 17th meeting, but the legal fight over Cook adds uncertainty to the message that would accompany any cut. Is the Fed easing strictly on the data or under perceived political duress? Markets care about both the move and the motive. What we're doing today. We're not litigating anyone's motives here. Our job is to explain 1. What the law and precedent suggest, 2. What history implies when politics and money collide, and 3. What practical signals to watch over the next few weeks. Part 1. The legal and institutional frame. How the Fed's structure works. The Federal Reserve Board of Governors has 7 members. Governors are nominated by the President, confirmed by the Senate, and serve terms of up to 14 years, deliberately staggered across administrations. Removal is permitted for cause, a phrase that sounds clear but is rarely tested. According to Reuters, no modern president has successfully removed a sitting Fed governor. Courts may now have to define what "for cause" means in practice, what independence does and doesn't mean. Independence doesn't mean the Fed is unaccountable. It reports to Congress and the president chooses nominees. But independence does mean policy decisions should be driven by macroeconomic data and the dual mandate, price stability, and maximum employment, rather than the short-term political cycle. That credibility helps anchor inflation expectations and stabilizes long-term rates, points widely echoed in mainstream coverage, including the Washington Post's explanatory articles. Part 2. The market context, September and beyond. Rate cut odds and why guidance matters. Heading into September, softer inflation and some cooling in the labor market have nudged the Fed toward calibration. According to Reuters, traders and strategists see a 25 basis point cut as the base case, with an outside chance of 50 BPs if the data slide. But the Cook case introduces a separate issue: forward guidance. Imagine 2 identical moves. Fed cuts 25 basis points. If investors believe it's based on data, front-end and long-end yields may fall in tandem. If they suspect political pressure, the 10- and 30-year yields might rise as investors demand compensation for inflation or credibility risk, dulling the stimulative effect of the cut, according to Reuters. The dollar, gold, and mortgages. Easing generally weighs on the dollar and can support gold. Long-term Treasury yields drive mortgage rates more than the Fed's overnight rate, so it's possible to see mortgage rates stay sticky even as the Fed trims at the front end, especially if independence concerns push long yields higher. PBS and market roundups have emphasized this distinction in recent coverage. Part 3. Why pressure the Fed if a cut is coming? Some viewers ask, if a cut is likely anyway, why the confrontation? According to multiple mainstream analyses, Reuters, Washington Post, there are a few neutral explanations observers point to, none of which we endorse or reject, but all of which help frame the discussion. 1. Controlling the narrative. If growth slows later, a White House can argue the Fed didn't act fast enough. If growth improves, it can say pressure worked. 2. Shaping the board over time. Changing who sits on the board can affect the policy center of gravity for years, not just one meeting. 3. Signaling to voters and markets. Talking loudly about rates tells households with credit cards or mortgages, we're focused on your costs, while also signaling to Wall Street. 4. Timing the cycle. A well-timed trim can cushion a soft patch. Overly forceful moves risk rekindling inflation expectations. The flip side, highlighted by economists and editorial boards, is the credibility cost. If political noise climbs, markets may price a risk premium into long-term yields, undercutting the very goal of cheaper borrowing. According to the Washington Post's reporting and analysis, that's the core tension right now. On Part 4, 3 plausible policy paths. Scenario A, a 25 basis point cut with data-dependent language. Baseline, inflation's cooler, the labor market has softened, so the Fed trims by 1/4 point. It reiterates that decisions remain data-dependent, not political. Equities likely firm, 2-year yields dip. The 10 and 30-year follow if credibility looks intact. If long yields rise on a cut, that's a market signal about credibility risk rather than macro relief. Scenario B, a 50 base pair cut with a hawkish twist. If payrolls and prices weaken more than expected, a half-point move becomes plausible. To protect credibility, the Fed would likely stress that it's not on autopilot and remains vigilant on inflation. Equities could pop on size, but break-even inflation might stay elevated if investors fear the Fed is behind the curve. Scenario C, no cut, independence first. A minority path, hold policy steady, emphasizing the need for more data and institutional distance from politics. That would likely tighten financial conditions, a firmer dollar, pressure on long-duration equities, and a higher for longer tone. The reward is signaling a hard line on independence. The risk is slower growth into year-end. Part 5. What History Teaches. The 1970s. A quick rewind. From the late 1960s into the early 1980s, the U.S. endured the Great Inflation, a mix of fiscal expansion, oil shocks, and policy choices that allowed inflation to seep into expectations. Once the public expects higher inflation, it becomes costlier to rein it in. That basic story still shapes central bank thinking today, according to the Federal Reserve's own historical essays. Nixon, wage price controls, and pressure on policy. In 1971, President Richard Nixon ended dollar convertibility to gold and imposed wage and price controls. Controls offered temporary relief but distorted markets, and when removed, prices rebounded. At the same time, historians document political pressure on monetary policy under Chair Arthur Burns, a combination many scholars believe helped entrench inflation expectations. According to Federal Reserve history and other BLS-FRB resources, these were costly lessons. When the bill came due by 1980, year-over-year inflation was in the double digits. Chair Paul Volcker changed tactics, fighting inflation by targeting money growth. The federal funds rate soared toward 20% in late 1980/early 1981, crushing inflation but also triggering a deep recession. These facts are well documented in Federal Reserve history and BLS research publications. Parallels and differences. This isn't a one-to-one replay. The economy is more globalized, the Fed is vastly more transparent, and the 2% inflation goal is explicit. Yet one thing hasn't changed. If politics are perceived to steer the wheel, inflation expectations can drift. That expectations channel is the quiet force that can turn a 25 base pair cut into either a healthy boost or a warning flare in the bond market. Part 6. The Cook Case. Signals to watch court timetable and voting status. No one knows the exact timing, but according to Reuters, the Fed says Governor Cook will seek a judicial ruling on her right to remain. 2 practical questions matter for markets. 1. Will she be allowed to vote at the September meeting? 2. What standard will a court apply to define for cause removal? Even an interim order could set an important precedent for the Fed's guardrails. board composition, and the center of gravity. Separate from the lawsuit, open seats and future nominations can shift the center of gravity on policy. Observers will inevitably label candidates hawk or dove, but the market's bigger concern is whether the overall institution sounds and acts independent. That tone can move the entire yield curve, not just the overnight rate, as emphasized in mainstream economic coverage. Part 7. Investors Checklist 1. The statement and the press conference. Don't stop at the rate line. Listen for how Chair Powell frames inflation progress, labor softness, and risk balance. If the language clearly anchors to data rather than politics, that's a green flag. 2. Long bonds and break-evens. Watch 10 and 30-year yields and 5 and 10-year break-even inflation. If the long end rallies with the front end, credibility looks intact. If long yields rise on a cut, the market is charging a credibility premium, undoing some of the benefit to mortgages and capex. 3. The dollar and gold. Orderly easing often means a softer dollar and a bid for gold as a hedge. Abrupt moves can signal a credibility scare. Again, it's not the direction alone. It's whether the moves align with a data-driven narrative, as recent PBS market explainers note. 4. The legal docket. Court filings or orders in the Cook case will swing headlines. A clear ruling, whatever it says, reduces uncertainty about the separation of powers around monetary policy, according to Reuters legal reporting. Part 8. What this really means for you. Here's the bottom line. Over the next month, headlines will be loud. Some will say the Fed is too political. Others will say the White House is just seeking relief for borrowers. Set the noise aside and focus on the signals. Do long-term yields move with the Fed's direction or against it? Do inflation expectations stay anchored after the meeting? Does the Cook litigation clarify the rules of the road? If those answers trend the right way, the path to lower borrowing costs remains open. If not, markets may add a risk premium, raising mortgage rates and corporate borrowing costs even if the Fed is cutting at the front end. These aren't abstractions. They're your credit card APR, your mortgage refi rate, your small business line of credit, and the valuation multiple on your retirement portfolio. Independence isn't about protecting technocrats from accountability. It's about protecting your future from the whipsaw of short-term politics. The 1970s taught us how costly it can be to lose that anchor. Let's not relearn those lessons the hard way, according to the Federal Reserve's own historical record. And BLS data decode the markets, protect your future. If you found this analysis useful, don't forget to like the video, subscribe to the channel, and hit the notification bell so you don't miss future insights on markets and policy.